G-Day. If you're 55 or over, and you've ever wondered whether you can actually get your hands on some of your super before you fully retire, this one's for you. By the end of this video, you're going to know exactly how a strategy called transition to retirement works, and I'll walk you through a real-worked example showing how it can put an extra couple of $1,000s back in your pocket every single year, completely legally, straight from the ATO's own rules. Let's sort it out. So what actually is this thing? Transition to retirement, or TTR for short, lets you start drawing an income from your super while you're still working. You don't have to fully retire. You don't have to cut your hours. You don't even have to change your job. You just start a special type of pension account, sitting alongside your normal super, and it pays you an income stream on top of whatever you're earning from work. Think of it as easing the tap open rather than turning it fully on. Your super keeps growing in the background, but you've also got a second income stream coming in from it right now while you're still on the payroll. Now, who can actually do this? According to the ATO, you need to have reached what's called your preservation age. And for pretty much everyone in our audience today, born before July 1964, that preservation age is 60. So if you're 60 or over and still working, you're eligible to start ATT or pension, full stop. No need to reduce your hours. No need to prove anything to your employer. The other thing worth knowing, there's no minimum super balance the ATO sets to start one, but most funds want a reasonable amount sitting in there to make it worthwhile, because you're limited in how much you can draw out each year. The rules say you can withdraw between 4% and 10% of your TTR balance annually. Any less than 4%, and it's barely worth setting up. Any more than 10, and you're not allowed to anyway. Right? Here's where it gets genuinely good, and this is the bit most people miss entirely. Once you're 60 or over, any income you draw from ATT or pension is completely tax-free. Not concessionally taxed, tax-free, according to the ATO. That's the same rule that applies to a normal retirement pension, except you get it while you're still earning a wage too. So here's how people actually use this to their advantage. Say you're on $90,000 a year. Instead of taking that full salary as cash in your bank account, you ask your employer to salary sacrifice an extra $15,000 a year into your super instead. That $15,000 only gets taxed at 15% going into your fund. That's $2,250 in tax. Compare that to what you'd have paid on it as normal salary, at your marginal rate plus the Medicare levy, roughly 34.5% for that portion of your income. That's about $5,175 in tax. Now, obviously, you've just taken a $15,000 pay cut to your take-home income by doing that. This is where the TT or pension steps in. You draw that same $15,000 back out, tax-free, from your TT or pension. Your day-to-day cash flow stays exactly the same as before, but you've just saved roughly $2,900 a year in tax, simply by moving money through super instead of taking it straight as salary. That's not a rounding error. That's real money, every single year, for doing basically nothing except filling out a form with your employer and your fund. Now, tell me, how old are you, and roughly how much have you got sitting in super right now? Drop it in the comments, and I'll give you a straight answer on whether this strategy's worth setting up for you. Here's the bit that annoys me a bit, if I'm honest. Most people don't even hear about TTR until they're 64, 65, right on the doorstep of full retirement. By that point, you've missed years of this tax saving, quietly, without even knowing it was sitting there available to you. The other mistake, people set it up, but don't actually increase their salary sacrifice at the same time. If you just start drawing ATT or pension without boosting what you're putting into super, you're not really getting the tax benefit. You're just moving your own money around for no real gain. The whole point is the combination. Sacrifice more in, draw the replacement income back out tax-free. One more thing worth knowing, straight from my.gov.au. The earnings inside your TTR account, while you're still working, can still be taxed at up to 15%, same as your normal super, because it's not treated the same as a full retirement account yet. That only changes once you actually retire or turn 65. Doesn't cancel out the benefit, but it's worth knowing so there's no surprises. If that tip's been useful to you so far, chuck a like on this video. Genuinely helps more people in your situation find it. So what do you actually do with all this? First, check your preservation age is 60 or above. Most of you watching this already are. Second, Have a chat with your super fund about opening a TT or income stream. Most major funds have this online now. It's not a complicated process. Third, and this is the step people skip, talk to your payroll or employer about increasing your salary sacrifice at the same time you start the TT or pension, otherwise you're leaving the real benefit on the table. And fourth, get a licensed advisor to run the actual numbers for your specific salary and balance, because everyone's situation's a little different. And look, if you're already using transition to retirement, or you've been thinking about setting it up, just write yes in the comments below. I'd genuinely love to know how many of you are already onto this. If you're working on getting your super and retirement sorted properly, hit subscribe so you don't miss the next one. There's a fresh video like this every week, breaking down exactly this kind of stuff in plain English. This video is for general information only and isn't financial advice. Always talk to a licensed financial advisor before making decisions about your super.